Would you like to pay off all of your debt and achieve financial independence through business ownership and real estate investing so you can leave a legacy for your family? In this video series, I'm going to show you how to go from living paycheck to paycheck to becoming completely debt-free and owning a seven-figure property portfolio in just over a decade so you can achieve financial independence and build a legacy for your family. And I'm going to do this by sharing with you the #1 millionaire money secret. Okay, and this is a secret that wealthy families, they've been using this for years to pay off debt quickly, create massive leverage, and build seven-figure real estate portfolios in record time. And this technique will allow you to always win the banking game, regardless of the economy or market conditions. You know, the unfortunate truth in this country is that most people are simply put never taught anything about money. And because of that, most people only learn how to work for money, but never learn how to have their money actually work for them. And that's why we believe this money secret is truly the key to you unlocking financial independence. As we go through the video series, I'm also going to be sharing with you the #1 wealthy mindset shift that you need to make if you truly want to take control of your finances and navigate this rigged system. And yes, the system is rigged. Okay, this picture kind of says it all. But do you really think it's by chance? You know, that in this country, most people really struggle when it comes to debt. You know, we're buried underneath our mortgage. We're buried in student loan debt. We have credit card debt. And because of this, you know, most people end up paying boatloads of money, okay, worth of interest, you know, going directly to the big banks over the course of your life. And, we take out the student loan debt, to get a job, and we're raked over the coals. You know, W-2 is the most expensive way to pay taxes, so we're raked over the coals in taxes. And in this economy, what we're seeing is that most people work their entire life just to retire completely broke with nothing left to pass down. So it's not working. We got to take different action. And most people are truly caught in a vicious financial cycle. So I'll show you how to break that cycle so you can eliminate your debt and start getting ahead financially. And finally, if you're on the line here and you're a part of this video series, I'm very excited for you. If you have a mortgage, okay, student loans, or any debt at all that requires you to pay interest, you're going to want to stick around all the way until the end. I'm going to show you how you can legally, morally, and ethically pay off all of your debt, even a 30-year mortgage, okay, in a fraction of the time without refinancing or sending in extra payments. This technique alone will save you tens, even hundreds of thousands of dollars over the course of your lifetime worth of interest that would normally just go to the big banks. The truth is that most people out there do make enough money to become financially free. They just don't know how to use their money right. Hi, I'm Mike Adams. I'm a President's Advisory Council member for a real estate investor training and education company. I'm a serial entrepreneur, and I'm also an independent marketing affiliate with that company. And behind all the titles, who am I really? I'm a married father of twins from right here in St. Paul, Minnesota. I'm a military veteran, so I was in the Army for 6 years, and so I was a combat engineer, so I dealt with landmines and explosives and demolition. And from that, I transitioned into being a corporate drone. So I was in corporate America for 18 years, and I was a really good company man. And my wife and I, we thought that we were doing everything right. We went to school, we got the good grades, we got the degrees, and we're making six figures out there in our jobs. We thought that we were on our way. We were told to do that. That's what we did. We thought that we were on our way. But the bottom line is, behind it all, my wife and I were really struggling. With the student loans, with the mortgage. We each had car loans, right? And then we incurred some medical debt, with conceiving and delivering our twins. So we were really buried in debt. And every single month, even though we made good money, every nickel that came in the front door was going right out the back door with all of our different bills and expenses. So we were really just going paycheck to paycheck. And it really wasn't until we got connected with this investor group that we really saw that there was a different way that we could start living our life, treating our finances, and how we could utilize money in a much different way. And ever since that moment, our life has completely changed. So my wife and I have been able to transition out of corporate America into doing this full time. We've been able to grow as leaders within this investment community. As a speaker and trainer, I am able to travel the country, and I do a lot of training like this live across the country as well. We do a lot of webinars and online stuff as well for our national team. And in my two most important roles, as a husband and as a father, for one, my wife and I have been able to build a business where 90% of what we do is right out of our house. So we're able to spend all that time together, and that was very, very important for us when we decided to move into this type of a business. And so now that you've learned a little bit more about who I am, before we move forward in the series, let me make sure that we're clear on who I'm not as we go through this series. Today, and really throughout this whole series, I'm not here as a licensed attorney, accountant, financial advisor, broker, or any other licensed individual. Okay, therefore, I'm not here to discuss or provide any specific counsel, advice, or instruction that will apply to specific individuals. Now, imagine what it would be like to be completely debt-free and get that big old debt monkey off your back. What would it be like to become financially independent and truly, have an opportunity to fire your boss, and get out of your job and truly start living life on your terms? That's what's possible, when you have the right set of systems, the right frameworks to follow and the right team of people around you, to support you and help you with implementation. So the top 4 categories of people that this video series will help with the most. Number 1, people with a mortgage, other loans or debt that they would like to pay off and eliminate much, much faster. This is also for those that are looking to get out of their 9-to-5 job and build a successful business of their own. This is also for individuals and business owners that want to maximize their current income and create a cash flow retirement for themselves. And this is also for new and experienced real estate investors that are looking for the best ways to create maximum leverage in their business. So if you're here for any of those 4 reasons, then you're absolutely going to love what you're going to learn in this video series. So let's dive right into the details, guys. I'm excited to pull back the curtain right now on this number 1 millionaire money secret. And the secret is actually a strategy. It's a strategy, real estate acquisition strategy, and also a debt reduction strategy that we call the velocity banking strategy. So what is velocity banking? Well, for starters, it's a more financially efficient way for you to use your current income to maximize your cash flow, create massive leverage, and help you pay off your debts in a fraction of the time. And we're going to be able to do this using tools that are available at the bank that anybody can use. You just need to know how to use them properly. And unfortunately, this kind of stuff just isn't taught in most schools, and what are we taught? Let's talk about that for a second. What are we taught in most schools? We're taught the Pythagoras theorem, right? And how important this triangle is to your everyday life. I remember this: a squared plus b squared equals c squared. That's very important, right? They made sure that we knew this. But when it came to basic finance or things that are as simple as balancing your checkbook, they left this out, unfortunately. There is a reason for this, and Henry Ford said it best when he said that if people actually understood how this economic system works, there would be a revolution in a minute. A critical point to make here is that everything that you know about the banks, you learn from the banks, inside of their mailings, their advertisements, their commercials on TV. And there is a certain way that banks would like for you to think and act in order to increase their profits, And so always know this, banks are in business to make money. So let's take a look at this, Let's take a look at the traditional banking model that we are all taught. And for the rest of this video series, we're going to be referencing the numbers here of the average American household. We put together this average American household scenario that we're going to be using as an illustration, to show you how this strategy works. So this is a hypothetical scenario to truly show you how this strategy works. So here's what we know, talking about the traditional banking model, is that in this average American family, we have $5,000 worth of income coming into the household, And the traditional model is that whenever you get your paychecks, you immediately take them down to the bank. We have been programmed and wired to bring our money directly to the bank because they know what's best to do with it, right? We're going to uncover this. But for us, what do? We bring the money to the bank, we cash the check, and we start chopping up that pie, right? And some of that money goes into checking, some of it goes into savings. And immediately when you look at this average American family, let's just chop it up right now. We have $1,200 going to a mortgage payment, which is attached to a loan. We got a 30-year fixed loan here, $200,000 mortgage, 6% interest rate. We got a car loan here, $600 car loan, $25,000 loan there, 6% interest rate. And we also got some credit card debt. The average American household has some credit card debt here. So we have a $15,000 line of credit, and we've racked up $12,000 balance on that card. Okay, so we got a 21% interest rate, $600 per month payment. From there, we got a $1,200 lifestyle here. So think about your phone, your cable TV, your Hulu, whatever it is, your phone, your food, stuff like that. And then from there, we got $1,400 left over that is typically just going to either A, go into the bank savings to be peeled off from throughout the month as you need it, or some of that's going to go into like an IRA. Maybe it's going into the 401k at your job, or 529 for the kids, something like that, where it's not earning a very great rate of return. But either way, this is the typical banking model, okay, that we're all taught. And the biggest problem with this model, okay, is that we got $5,000 worth of income coming into this household, right? But every single nickel of it is accounted for, right? We got $5,000 coming in, but we got $5,000 going out every single month with expenses. We have zero cash flow in this model. And there's an old saying, and it's been said, that wealthy folks and rich folks, they're playing chess while everybody else is playing checkers. Well, what you're seeing on the screen here, this is your chessboard, okay? These are your moving pieces, and these are your moving pieces right here, and it's time to understand how these pieces work, okay, on your own personal chessboard. And this really ties in with, how do banks make money? How do they make money from the model that we just showed you? What banks get to do is they get to leverage other people's money to make money. They get to do what's called fractional reserve banking, and you can take some time, you can Google search that. But a critical point to make here is that each time you pay the bank for your house payment or deposit money into your savings, that money gets turned by 10, and 90% of it is borrowed out again to somebody else, okay, at a higher rate of interest. And that's a little bit of a tongue twister. Okay, let me give you a critical example on this. And so when you have that $1,400, right, from our average example, sitting in the bank savings, the bank now has the ability to go to the Federal Reserve and get a loan for $14,000, okay, at a fraction of a point in interest. And now they have to keep $1,400 of that $14,000 on their ledger. So they have to hold on to 10% of it. But now, okay, they have that other $12,600 that they get to lend out, okay, to somebody else at a much higher rate of interest and make money. Okay, so banks make money by lending out money and charging people interest. And where did that additional $12,600 come from, you might ask? Well, it comes from thin air. Okay, it doesn't exist. Okay, it's merely a number on the bank's ledger. But just understand this, that this number puts more money in circulation, and the banks and the Federal Reserve are making money by charging us interest on nothing but numbers. And this is why, right, this is why banks always have the nicest buildings in town. They have everybody's money, and they get all the leverage. And why is this a problem? Right? Why does it sound like I'm so fired up about this? Because it's your money, okay? And if anybody should be leveraging your money to make more money, shouldn't it be you, okay? Albert Einstein said this, compound interest is the eighth wonder of the world, okay? He who understands it earns it, he who doesn't pays it. And that brings us back to our traditional banking model here. And now that you know a little bit more about how banks make money, okay, by charging people interest, now we need to understand a little bit more about our chessboard here and how these moving pieces work. Because our average American household example here, we have some loans and we have some lines. But what is the difference? Okay, well, we know that there is a difference, but what is the difference between a line of credit and a loan? Well, for starters, guys, these are the two primary products that banks offer to consumers. What is a loan? A loan is a one-way lending instrument where you have a fixed monthly payment, and each payment consists of principal and interest, right? And it has what's called an amortized repayment schedule, where at the beginning of your loan, you're going to see front-loaded interest. Like a big chunk of your payment is going to be interest right off the bat, especially on a mortgage. It's going to be interest right off the bat, and a smaller portion is going to actually affect the principal. And then over the life of the loan, okay, it actually evens out. But that's an amortized repayment schedule. I'll show you an example later here in the training. And when it comes to loans, right, a loan, this is the product the banks most readily offer. I mean, most people are pretty familiar with loans. We got student loans, mortgage loans, other car loans, right? So most people are pretty familiar with loans and probably have loans. And the biggest problem with loans, the biggest problem here is that the principal is not liquid, okay? So you do not have access to your money. So even though you send in principal every month on that payment, okay, so in our example, we have the $600 car payment. If 300 of it is principal, 300 of it is interest. Once you send in that full 600, you never get to access that 300 of principal ever again, right? If an emergency comes up, you send an extra principal on the loan, you can never re-access that money, okay? And why? Because the banks have it, right? And once the banks have it, they get to leverage your money. Okay, so again, loans are a one-way lending instrument. You can put money in, but you can't take money out. Okay, now is it possible for you to create leverage with your money like the banks do? Yes, okay, the good news is the answer is yes, but you just can't do it with loans. So what is a line of credit? Well, a line of credit is a two-way lending instrument. Okay, that means it's revolving. And there's only a payment if there is a balance, okay? So if you have a zero balance on your credit card, there won't be a payment. There won't be any interest. The payment reduces the principal balance, and then interest is charged at the end of the billing cycle. And it's just got regular, simple interest on this line of credit. And over the course of our lifetime, we are taught that lines of credit are bad. And the bottom line is, a line of credit is a tool. Okay, and most people are just never taught how to use lines of credit correctly. Most people use lines of credit for liabilities. They use it for their big screen TV. They use it, critical point to make here, guys, is that lines of credit, they are for emergencies and for the acquisition of assets. That's it, okay? And if you limit your exposure to lines of credit to just those two things, lines of credit can be very, very powerful tool that you can use inside of your toolbox. Okay, and the great thing about lines of credit, okay, when you send money to lines of credit, is that the principal stays liquid. Okay, you have access to your money in the form of leverage in the line. So like in our example, we have a $12,000 balance on that credit card. If we sent all $5,000 to that credit card, it would knock the balance from 12 down to 7, right? Do we still have access to that $5,000? Yes. Okay, because we've created that new available credit in the line that we can access, that we can leverage. And we can leverage that to build wealth, just like the banks do. And this is what gives you the ability to leverage your money instead of the banks. Okay? Bottom line, key point here is if you aren't going to leverage your money for financial gain, the banks definitely will. Okay? So, and that brings us back to our critical example. And now that we understand a little bit more about the difference between lines and loans, we know that loans have an amortized repayment schedule. That means they front load the interest. And it's also just a one-way lending instrument. We can put money in, but we can't take money out. When it comes to our lines of credit, we know that they just go by daily simple interest. Okay, and it's also a revolving tool. We can put money in and we can take money out, which gives us access to the leverage. And so now that we know a little bit more about these tools, let's take the next step here. Because what is the difference here when it comes to the interest? Why do we see the big 21% when it comes to our line of credit, but we only see 6% when it comes to our loan, right? Does that mean that we're gonna pay less in interest, right? And a critical question to ask you, hey, if you were going to borrow some money from me and I asked you, would you rather pay a 6% interest rate or a 21% interest rate? What would you choose? Most people would literally just dive right on the 6, okay, simply because the number is smaller. But does that mean that we're actually going to pay less in interest, okay? So again, a critical point to make here between lines of credit and loans, Yes, you have to pay interest on both. Lines have, yes, you have to pay interest on lines, but loans have, again, what's called an amortized repayment schedule. They're amortizing the interest. And these are two completely different systems used to calculate interest. Okay, and I'm from Minnesota, so think about the difference between Celsius and Fahrenheit. Okay, so these are both different ways to measure temperature. But did you know that 1 degree Celsius is actually hotter than 32 degrees Fahrenheit? Okay, so even though the number is smaller, okay, it's actually hotter than the bigger number. So when you're thinking about your interest and the difference between lines and loans, think about your amortized interest or anything that's on an amortized repayment schedule. Think about that as Celsius, and think about your regular simple interest on credit cards or on your line of credit as Fahrenheit. Okay, because that amortized interest is much, much hotter and much, much more expensive. Let's take a deeper look at this 30-year fixed mortgage that our average American household has. And what we see here is when you send in, here's your typical amortization schedule. And over the course of 30 years, when you send in that first payment, the biggest portion of it's going to be interest, small portion is going to be principal. And then at the end of the loan, it'll be the opposite. But what we see is on that very first payment of $1,200, only $200 is knocking down the principal. And $1,000 of the $1,200 is pure interest going right to the bank. Okay? And understand this, if you're somebody that has a mortgage, okay, and you've been making your payments for years, understand that most people never pay off their 30-year mortgage, right? And why? Typically around here, around year 4, 5, 6, 7, if you've been making your mortgage payments on time, you're going to get a call from the bank and they're going to say, hey, we can save you, $75 a month off your payment if you refinance your mortgage, right? And so many people jump on that refinance to save that a little bit on their monthly payment. But what that does is it effectively resets the amortization. Okay, it brings you back to the front end of the loan where the biggest portion of your payment is going to interest right to the bank. The majority of people spend the majority of the time they live in their property in this end of the loan, where the majority of their money is just evaporating right to the bank in pure interest, okay? And here's the bottom line. With this particular loan, over the first 4 years of this mortgage, you will send in $57,000 worth of payments on this loan, and only $12,000 is going to knock down the principal on the loan. $45,000 of that is pure interest going right to the bank. So you might be wondering, is this accurate? And you can definitely, I expect you to do your own due diligence here, but I found this on calculator.net, and you can look at the first 4 years of this amortization schedule. And you can see in the first year, you're looking at $11,900 in pure interest going to the bank. Year 2, $11,700. Year 3, $11,600. Year 4, $11,400. Going right to the bank in interest. Okay, and you're only knocking down the principal by a couple of grand every year. And the bottom line, guys, is over the course of this loan, okay, if somebody did actually pay this off over the course of 30 years, well, congratulations. You'll have paid a total of $231,000 worth of interest on this property. That's a lot of interest, folks. And now that you know, okay, the difference between a line and a loan, and now that you've learned, okay, a little bit more about how brutal amortized interest and amortized loans actually are. Again, student loans work exactly the same. Let's take the next step here in our journey, and let me share with you the number one wealthy mindset shift that you need to make if you truly want to take control of your finances and navigate this rigged system. And who rigged the system, you asked? Well, of course, it's your friends, okay, over at the big banks, big corporations, and the government, of course. And you might be asking why. Why did they rig the system? Well, to make money, of course. The unfortunate truth is that the government and the big banks have been grooming you since you were a kid to get used to giving them your money. Now, I want you to think about this, because since you were a kid, you've been hearing this language that if you want to be something in this world, you need to go to school, get good grades, get a degree so you can get a great job and work your way up. Or the only two things that are certain in life are death and taxes. You were told to not take any risks, to always play it safe. And let's say you did ever make any money, they told you to not spend it all in one place, kid. This old school mentality, it's really, what this is really scarcity language. Okay, and this language really starts to force you down a certain path in which you're going to live your life. And you start to develop what we call the employee mindset. Okay, and this is a way of thinking. And the biggest problem with this mindset is that we only learn how to work for money and really exchange time for money. We only learn how to live on a cash system. And we only learn how to use cash as currency. And because of that, we relentlessly focus on accumulating cash. And that's why most people spend their entire lives, chasing a dollar. Okay, the critical problem with this employee mindset is that there simply put is no leverage. You are exchanging hours for dollars. And the minute you stop exchanging for those hours for dollars, right, the dollars are going to stop coming in. Right? So if you stop going to work, you're going to stop getting paid. It takes your time in order to keep the money coming in. Okay, that's exchanging hours for dollars. Now, do wealthy folks want to accumulate cash? Yes, they do, right? But they want to do it in a different way, right? And that is not their focus, right? Accumulating cash is not their focus. Cash accumulation is a byproduct of the two things that wealthy people focus on creating relentlessly in their life and in their business, which is cash flow and leverage. Okay, those are the two things. So what is cash flow? Well, cash flow is your income minus all of your expenses. What's left over? That's your cash flow. Okay, it's the money you have left over after all of your bills are paid for the month. And see, in life, we're taught to focus on what we make, right? Our gross annual salary or our hourly pay, and not so much about what we keep. Okay, and this is truly the mindset shift that we need to make here. Okay, you see, wealthy people, they think completely different. You see, they have what's called a wealthy mindset. You see, wealthy mindset individuals, they're not interested in exchanging time for money. Okay, they know their time is much more valuable than that. Wealthy mindset individuals are not interested in using cash as currency. They know that there's a better use for cash and a different way to use cash. You see, and wealthy mindset individuals aren't interested in exchanging their time for money. Wealthy mindset individuals are not interested in exchanging or using cash as currency. You see, wealthy individuals use cash as velocity to pay down their debts quickly and reduce interest payments. They create leverage in lines of credit, and they then use that leverage as currency. That's why most rich people aren't carrying cash. They usually put everything on a card. They're using leverage as currency. And they use it to pay for their lifestyle, okay, their monthly expenses. And since the lines are simple interest, they then turn around and leverage those lines of credit to pay off their expensive amortized loans much, much quicker and save a boatload of money in interest. You see, wealthy mindset individuals are not interested in sending their extra cash to loans. They know that once they send in that extra principal, they lose access to it, and they lose all the leverage to the banks. Wealthy mindset individuals also don't use bank savings accounts, right? Because the banks are not paying you very much interest there. And you can see what they get to do with that money. They get to go charge somebody else an amortized loan. Well, they turn around and give you a fraction of a point in interest. Okay, there's different vehicles, right? Do you want to have a liquidity fund? Yes, you do. But there's other vehicles like cash value life insurance, for example, where you can put that money there and have a liquidity vehicle. But wealthy mindset individuals do not use bank savings accounts. So what would the wealthy do? And what would the wealthy do with our average American household scenario to help them get out of debt much, much quicker? Well, now that you know the difference between a line and a loan, the importance of cash flow, and the power of leverage, let's take the next step here. And let me show you how this powerful velocity banking strategy works and how we're going to use it to help this average American household get out of debt in a fraction of the time here with their current income. So let's start applying our wealthy mindset here to this average American household scenario. And remember, before we get started, the two things that wealthy folks focus on creating relentlessly are cash flow and leverage. Okay, so we want to focus on creating those two things. And so what we see, and again in our scenario here, is that we had $5,000 worth of income coming in and $5,000 going out. So we have zero cash flow. So first things first, we need to look at where can we create some leverage. We know that if we take our $5,000 and send it to the loans, we lose all the leverage there. We can't create leverage doing that. The only place that we can create leverage in this scenario is right there in that line of credit. So applying our wealthy mindset, what would a wealthy person do with this scenario? Is they would start taking all $5,000 of this income and sending every single nickel of it every single month directly to the line of credit. Okay? And let's take a look at what it does to our numbers here. And what that does, by sending all of your income to the line of credit, it eliminates that $600 payment. We no longer have to account for that because all $5,000 going in there throughout the month will cover that payment, right? It'll cover that requirement, so you no longer have to account for that. We can take that $600 and add that to our cash flow number. Also, that now that we've learned a little bit more about leverage and more about bank savings accounts, okay, and how we don't really get a lot of leverage there. Okay, we're gonna take that $1,400, we're gonna add that number directly to our cash flow. In this scenario, we're trying to get rid of the debt. So we're gonna stop leaving money in the bank savings there and put it directly into our cash flow. And so what we've done here is we've done a little financial shift and we've changed our numbers here a little bit. We still have the same $5,000 worth of income coming into the house, but now we have a $2,000 cash flow number and $3,000 going out in expenses. So we have $5,000 coming into the household, we have $3,000 going out still with all of our expenses, but we now have a $2,000 cash flow number that we're gonna use to start knocking down our debt. And so bear with me here, okay? Let's take a look at what this does to our line of credit. Let's run the numbers here. And a critical point to make with this is you wanna think of your line of credit as your new checkbook. Okay, you're gonna use that as your new checking account at the bank. Okay, you're gonna pay all of your expenses using the line of credit instead of sending checks from your bank account, okay? And so let's play this out on our line of credit. So month one comes rolling in and you got $12,000 balance on this $15,000 limit card, okay? And so you got a $12,000 balance and you're gonna hit it with that $5,000, it's gonna knock the balance down to $7,000, okay? Then you're gonna use the line of credit to pay for all of your expenses. So you're gonna pay your mortgage, pay your car payment, pay all of your lifestyle expenses using the line of credit. So $5,000 in and $3,000 out in expenses. And what we see is a debt reduction by our cash flow number. So in month one, it went from $12,000 balance down to 10. That's fantastic. Month two comes rolling in, 5,000 in, 3,000 out, down by our cash flow number. Month three, 5,000 in, 3,000 out. So went down by our cash flow number. And most people, when they're seeing this scenario for the very first time, they're like, well, Mike, I can't do that. What if there's an emergency or something happens? If I send all my money to the line of credit, what if something goes wrong? And here's what's the beauty of doing the strategy this way. Like, instead of just sending the extra money from your savings to the line of credit, if you do it that way, you have no leverage. Okay, your money's gone to the bank and you have no leverage. You leveraging the line of credit here, you have this available credit, right? In month three here in our scenario, you have $9,000 worth of room on this line of credit that you could use, right? You have the leverage. So if something did go wrong, you would be covered, okay, versus just sending the money from your bank savings account. This gives you the leverage. This gives you the safety net to actually get all of your money working for you. Okay, so no emergencies here in our scenario. So barring emergencies, this will go down by our cash flow number every single month. And simple math, $12,000 going down by 2 every single month. It would take about 6 months to pay down this line of credit using this strategy. And again, just shifting the way that we're using our current money. And so now that we've paid off the line of credit, we've been able to clean up a little bit of the debt here. What can we do now? All right, what's the next step here to eliminating all of this debt? Well, you remember that expensive amortized mortgage that you have? Let's take a chunk of that amortized debt and move it over to the simple interest line of credit. Okay, transforming the interest, you're paying on that debt, making it much easier for you to pay off. So again, now that you have this line of credit paid off down to zero, you could take that line of credit, you could write yourself a check off that line of credit and send it all, principal only, $12,000, directly to your mortgage company. Essentially grabbing a chunk of that amortized principal there and bringing it over to the simple interest line of credit, okay? And then from there, we start running the velocity banking strategy where we got all $5,000 of our income hitting this line of credit. We still got $3,000 going out. And so we put another $12,000 onto our line of credit. Okay, it's gonna go down by our cash flow number every single month. So it's gonna go down by $2,000 in this scenario. It would take 6 months to pay this balance down to zero. And guys, that is $12,000 worth of mortgage principal reduction. Okay, if you remember from the beginning, and if you go back to this example here, Imagine being able to do a move like this at the beginning of your loan. If you were able to take a line of credit and grab a chunk of amortized principal and bring it over, is that when you prepay the principal, okay, this interest here, if you were to send in 12 grand on day one, this interest here in the box, you're no longer required to pay it. When you prepay the principal, you no longer have to pay that interest. Okay, you only have to pay that interest if you stretch it out over those 4 years. If you prepay it, you're no longer accountable. You jump right to 188 on your amortization, and then it keeps going from there. But the interest that you jumped over, you don't have to pay it. Guys, that's a huge savings. Okay, and that's why we believe that this money secret is truly the key to financial independence. And a lot of people will ask here, Michael, what about the interest on that credit card? If I'm using that credit card for 6 months, to knock down, I'm saving that huge amount of interest there. What about the interest on that credit card? Well, here's the formula for that. And so if you wanted to run the numbers on that, if you carried the $12,000 balance for the whole 6 months, even though you're knocking it down by 2 every month, over the course of, if you carried the 12 for 6, you would pay about just under $1,300 in interest on that credit card, carrying a $12,000 balance for 6 months at the 21% interest rate. Okay, but again, comparing that to, and that's again for $12,000 worth of principal reduction in your mortgage. Okay, it could be your student loan, right? But in this case, your mortgage. Okay, to get the same $12,000 worth of principal reduction in your mortgage, just sending in the monthly payments, it took us 4 years of payments. It took us $57,000 worth of capital, and you had to pay $45,000 worth of interest to get the exact same principal reduction in your loan. So you tell me, what would you rather pay in interest to get the same exact principal reduction? Okay, $1,300 worth of interest, okay, in 6 months, or $45,000 worth of interest in 4 years. Okay, that's a big time and money savings, folks. And again, you could rinse and repeat that process every 6 months. Pay down the line, grab another chunk of amortized principal, and bring it over to the line of credit. Bottom line is, by rinsing and repeating that chunking process every 6 months, barring emergencies, this average American household would pay off their credit card, the car loan, and their 30-year mortgage in about 6 years, leveraging this strategy. And the cool thing about it is we were able to break the shackle of debt, okay? And they were able to do it without sending in extra payments, without refinancing, without increasing their income, or even being forced to live on beans and rice. They didn't have to go without, simply started using this velocity banking strategy. And we're 6 years down the line now, and the beauty of this is now that we've eliminated the mortgage, we've eliminated that mortgage payment. So we can take that $1,200 and add that directly to our cash flow. And 6 years down the line as well, we've eliminated the car loan, so we can take that $600 and add that to our cash flow number as well. And so we got the same $5,000 worth of income coming into the household, but now we only have our lifestyle expense, which we kept exactly the same. Okay, and we have a $3,800 cash flow number. Now, I love this quote by Bob Hope. Okay, he once said that a bank is a place that will lend you money if you can prove that you don't need it. And here at this point in the scenario, it's very easy to see that the bank would offer you a line of credit increase. They'd probably offer it to you before this, since you've been using that line of credit effectively. Guys, banks reward this kind of behavior. Right? If you're a good saver, and you save money at the bank, they're not going to reward you with lines of credit. But if you start paying down lines of credit quickly, they're probably going to offer this to you much sooner. But let's say it took them till now to finally offer you a credit limit increase, because now you've eliminated the mortgage. You still have your job. You've eliminated the car loan. This credit card has a zero balance. It's very easy to see that they would offer you a $10,000 limit increase on your line. And what they're hoping for is that you're going to rack it up, with the liabilities again, so they can start charging you interest again. But now that you have your wealthy mindset, now you know a little bit more about how lines of credit work. You know that they are for assets and emergencies. That's it. So, so what can we do now with this line of credit? Because for most folks, and looking at this average American household scenario, right, for this average family, life is actually pretty good. We've been able to clean up the debt, okay? But we still got one big problem here. One big problem with this scenario. And the biggest problem is that, where is this $5,000 coming from? Okay, in this scenario, you've still kept your job, right? We kept that the same. And, and what if, your hours get reduced, your bonuses get cut, or you get laid off, or worse, even terminated, right? Unfortunately, about corporate America, what do we know? Is that for any reason, at any point, the boss could let you go. So what would the wealthy do about this? How would they protect themselves from this kind of situation? Well, again, remember guys, lines of credit are for assets and emergencies. And so now that we don't have any emergencies going on, we've eliminated the debt, let's use the leverage in the line of credit to accumulate additional cash flow producing assets. Now, if you remember at the beginning of this video series, I said that I would show you how to go from living paycheck to paycheck to becoming completely debt-free and owning a 7-figure property portfolio in just over a decade. Let's leverage the tools that we have available here on our new chessboard to create financial independence. And this is where you go a little bit deeper with your financial education. You learn more about real estate investing and how it actually works. And you could in this illustration, you could take this line of credit of $25,000, write yourself a check for $20,000 and buy yourself one of these, which would be your first single family rental property. And this property here has a market value of $120,000. So it leaves us with a mortgage of $100,000. And this door is going to cash flow $400 a month, which we can add to our cash flow number. So it brought us up from 38 up to 42. And now that we've racked up 20 grand worth of debt here on our line of credit, what are we gonna do? We're gonna start leveraging this velocity banking strategy, where now you got $5,400 hitting that line of credit every single month. You have a renter in this property, taking care of the debt service payment, right? So that's where the cash flow comes from. So again, barring any emergencies with that, barring any emergencies in your life, it's gonna go down by our cash flow number every single month. And so this 20 grand will knock this down in about 5 months. And guys, this is 20 grand worth of mortgage principal reduction, okay, at the front end of a loan. So we know the kind of interest that we just saved by doing this. We're able to wipe it out in 5 months. Go ahead and rinse and repeat. Grab another 20 grand off that mortgage, rinse and repeat that process. You would be able to pay off this first rental property in about 2 years, leveraging this velocity banking strategy. And so that'll change our numbers again. That'll get rid of the mortgage on the first rental property here. And so it increases our cash flow on there up to $1,000 in this scenario. And so it's gonna bring us up to a cash flow number now with our job of about $4,800 per month. And so is one little rental property enough for us to achieve financial freedom? In most markets, probably not, right? But what can we do now? Right? What other tools do we have available? I mean, sure, you could do another one with using the small credit card here, but what about this primary residence, right? What about this asset you have here? You have a fully paid off primary residence. Could you leverage that to build wealth? And the answer is yes. Let's stick it up here. Again, we're 8 years down the line, so the chances are this property has appreciated quite a bit, but let's just say it's still maintained its $200,000 value. This is a very good credit scenario for this average American household. You could easily walk into a bank. They're going to try to offer you a mortgage, but now that you know better, you're going to say, nope, I don't want the mortgage. I don't want the lump sum. What I want is the tool. I want the revolving tool. Let me get a home equity line of credit on my primary residence. And again, in this good credit scenario, easy to see that you could get a 60%, $120,000 line of credit on this property. And guys, using your new real estate education, again, go out there. You need to learn more about real estate investing to really do this. But how many $20,000 checks can you write with a $120,000 line of credit? Well, you can write 6 of them, okay? And assuming the same numbers as above, you could get 6 more rental properties. And assuming the same numbers, guys, exactly the same, that would give you an additional $2,400 per month in cash flow coming into your life and into your business. Okay, bringing us from 48 up to $7,200 per month, every month in cash flow. And so again, we paid off the credit card, $25,000 line of credit down to 0. You can put that in the drawer for now, because now we're playing with this big fat home equity line of credit that you just racked up $120,000 worth of debt on. What are we gonna do now? You're gonna start leveraging this velocity banking strategy where now you have all of this income knocking down this line of credit every single month, all of your expenses coming out. Okay, and again, barring emergencies, it's gonna go down by your cash flow number every single month of $7,200. So running the illustration forward, you'd be able to sweep down this initial 120 grand in about 16 months, leveraging this velocity banking strategy and barring emergencies. And by running the number, and then you would just grab another 120. Again, you got renters in these properties actually making the actual debt service payment, right? So you're able to grab another 120 off and rinse and repeat. Bottom line, guys, is you'd be able to pay off this additional 6 property portfolio here in about 5.5 years, leveraging this strategy. And that would give you a total of 7 rental properties paid off free and clear in just about 13.5 years. Okay, using this strategy. Guys, we were able to do this without changing your spending habits, without earning any additional income. Imagine if you were bringing in additional income on the side. Maybe you're doing some wholesaling, you're flipping houses on the side. That would make this whole scenario move much, much quicker. But we wanted to do this using everything exactly the same. Okay, so we didn't earn any additional income. We just simply applied the velocity banking strategy. And so after about 13.5 years, here's how we ended up. We ended up with a cash flow number of about $10,800 per month. So at this point, you could easily walk away from your job and still have $5,800 per month in cash flow coming in the door. Okay, and on the side of that, we have some additional benefits here. Okay, guys, at this point, you have now over $1 million worth of leverageable assets, and you have all the equity. None of these assets have debt. Okay, so and since you own rentals, you're getting incredible tax advantages like depreciation along the way. Rentals actually lose money on paper, so they're fantastic to offset some of your W-2. You're building a legacy for your family. Imagine handing down a portfolio of properties when you die. And in the meantime, you're creating a much more secure cash flow retirement for yourself. And how does that sound for a retirement plan? Versus the cash accumulation model that we're all taught. You would have to save up nearly $3.5 million in an account somewhere to be able to pull off 10 grand per month in retirement over 20 years. At your current rate of retirement savings, do you have enough time left to get to where you want to be financially? A good friend of mine, Mitch Nelson, says, when knowledge increases, behavior changes. And now that we have increased your knowledge, you can change your financial behavior to maximize your cash flow, create massive leverage so you can save thousands of dollars in interest using the velocity banking strategy. Now, just understand that what you've learned about today and what you've seen here is really just an overview of one component of our complete system. And there's still a lot of detail missing from this one component. But to truly achieve financial freedom through business ownership and real estate investing, there are 5 areas that you're going to need additional education and strategy. And we call these areas the 5 pillars of wealth, which are taxes, banking, business, real estate, and education. You're going to need systems around all of this. And many people do go out there and they try to figure out everything on their own. Again, you learned a little bit about our banking system today, but then there's the other 4 pillars of wealth. Right, and many folks try to crack the code on their own, to try to figure this out on their own, the real estate game, the tax game on their own. And the hard way is to really just continue on YouTube, jumping from video to video. You're on Google trying to figure it out. Your head's spinning, trying to piece it all together. You got information overload going on. The other route that most people go through is the celebrity real estate guru or the boot camps and seminars that come to your town. Maybe you've seen some of these faces on late night TV. And these gurus are charging folks crazy amounts of money. Some gurus are charging folks between $40,000 and $100,000 plus, for their top tier programs to learn about real estate investing and learn financial literacy. And with the gurus, most times you're on your own to try to figure things out by yourself. They put you on the phone with script reading telemarketers and coaching programs, things like that. That's definitely the hard way, to really learn this industry and gain access to leveraging the 5 pillars of wealth. Okay, the easy way to crack this code is to simply have somebody give you the code. And that's exactly what we do. And we truly take hardworking people from the W-2 world and turn them into financially literate business owners and successful real estate investors. And why do we do that? Because we know that that's what wealthy people do, right? 90% of millionaires became so through owning and controlling real estate. And after helping over 12,000 students start their own business and get on the right track to financial freedom, our team has systems and frameworks that are completely dialed in to help you be successful. So if you found value in this training, then we're truly just getting started. Click the button below to register for our company introduction webinar. On our company introduction webinar, you will learn how to crush the top 3 self-limiting beliefs that prevent 95% of Americans from ever getting out of their jobs or ever achieving financial freedom. You'll learn the 4 vital currencies that you absolutely need to become a successful real estate investor. These are truly the 4 reasons that you will or will not ever do any real estate. And you'll also learn the number 1 thing that wealthy people create that allows them to grow their wealth and have ultimate time freedom regardless of the economy or market conditions. So it's a very powerful webinar. You're definitely gonna want to take some notes on this. During the webinar, I'll share several student case studies showing what they've been able to accomplish using our proven education and support systems. And at the end of the webinar, if you're interested, again, you're gonna learn enough to potentially do some of these strategies on your own. But if you are in fact interested in connecting with our group or maybe partnering with our company and having us actually help you implement these strategies into your life and into your business, you'll be given the opportunity to schedule time to speak with myself or someone from my team one-on-one on the phone.